Hello everyone. I'd like to introduce you to Peter Stathis.
Hi Esther.
Hello Peter. Peter is an insurance guru. I've known Peter for a very long time. I'm not really allowed to say how long I've known him.
25 years.
Oh, 25 years there, you said it. And Peter has worked in a variety of roles across the insurance industry, has become an expert and now consults to financial advisors about how to introduce or enhance the insurance discussions that they have with their clients. So today I'd like to have a deep dive with Peter into the personal life insurance industry and hear Peter's thoughts on a variety of different topics. Welcome Peter.
Thanks Esther, it's a pleasure to be here and thank you for deciding to do this topic because I think it's very important.
It's funny you say that because it is obviously very important, but why do you think people have such a mental block when it comes to insurance?
It's the wonder of living in a lucky country that has universal health care. So Medicare in many cases does save most people. Knowing that they have that, perhaps having an over-expectation as to what Medicare can do, particularly if they have orthopaedic issues, but also the fact that a prescription might not cost more than, say, $30 in many cases. And this concept of having a fallback with the government, with a disability support pension, it just makes us really complacent. If you contrast that to, say, South Africa, where there is no safety net, and people have been acutely aware of their mortality and morbidity, and they also know that if they suffer a serious health scare, a life-threatening illness, a heart attack or a stroke, they know that they're on their own.
Right.
So they tend to be more focused on how do I protect myself and my family.
Right.
We're the opposite.
Okay, well, if I can share when actually I got my first life insurance policy, that might sort of tell the story a little bit more, and then we can talk about why it's so important for me in my practice to offer the service to my clients. When I first got life insurance, I wasn't even practicing as an advisor.
Okay.
I was a young single mum, and for me it was about maintaining my independence and having control over my life. If something were to happen to me, I was becoming independent again after getting divorced. And for me it was very important to know that I could still maintain the lifestyle that I was trying to build for myself and for my children without having to rely on my parents. Maybe that's oldest child mentality. I was responsible oldest child, so my parents are quite young, so they hadn't really finished setting themselves up for the future. And I just thought, I don't want to have to move back into my parents' house if something happens to me. If I'm going to be an adult, I've got to deal with all things adults have to deal with. And that's when I got my first insurance policy. And of course, like everybody else, not excited about having to pay for it. But then over the course of my career, boy, have we seen some circumstances where people have been paid out and the unbelievable difference it's made to people's lives, knowing that they can maintain their independence and dignity.
No, absolutely. The thing I've always realised from very early on in this career is that females, women, understand financial vulnerability far better than us men who think we're infallible. Right. So it doesn't surprise me in the circumstance that you were in that you thought, I have to deal with this potential vulnerability. Right. It's the most important thing.
Yes,
and
I was really scared. And for people who are dependent on somebody else, it would be even scarier because it's not just about what if something happens to me, it's what if something happens to the person that I'm dependent on. I mean, typically it's a spouse or a partner or a parent of a co-parent of children. So so I came to insurance before I even understood and appreciated what a foundation it is for people's financial plans, and that's where I'm seeing as a professional in the business that if we're trying to secure people's future and provide a wealth accumulation strategy so that people know now, soon, later that they have what they need for their lives, the last thing you want is the foundation or something to be pulled out from underneath that brings it all crumbling down and leaves you with a life of destitution and dependence.
Potentially. And look, people just don't realise how fragile financially we could become if you woke up one morning or one night with your family around you and you go, where am I? And you go to speak, you can't find the words. These are true stories that have been taught to me. And your loved ones are saying, Peter, you had a stroke, right? Everything will be fine. Okay, but ultimately you start thinking about, hang on a minute, there's bills to pay, there's a mortgage, there's my kids' school fees. The one thing that sustains you and maintains your lifestyle, which is your ability to earn, is also the thing that's going to get you to a comfortable retirement and give you that financial well-being. That's really the business you're in as a financial planner now. So that solid foundation, that plan B, is the thing that as consumers we don't think about, because we tend to see premiums before we think about what good is this.
Absolutely. And Peter, I'm sure you can tell, so many stories of things you've seen professionally. And, when you get to our age, we've seen things that happen in our lives, whether it's in our families, our friends, our loved ones. I've got to be honest that I can't help when I hear of a tragic circumstance happen. The first thing that goes through my mind is, I hope they had insurance.
Me too.
And I've been compelled so many times when there's been an incident of something where I've wanted to write a blog or put something out there and comment, and I just feel, it's distasteful and people are going to think I'm pushing for business. But no one, as you know, no one comes to buy insurance. Something like life insurance needs to be sold and presented to people. And as much as, as you said, we live in the lucky country, things are changing and it may not always be as lucky as we think it is. I mean, it's great for now. We do have a healthcare system that we can depend on for now, but things change all the time. So tell me a little bit more about some of the barriers that people have to insurance and some of the hidden risks.
Yeah, look, it's more complacency than barriers. We in this country have a superannuation system that these days is making material contributions from your wage into this fund that will sustain you in retirement. When we finally reach a stage where maybe there's $10,000 in the account, you're in your early 30s or late 20s, you start looking at that statement and you finally realise, there's life insurance here.
Right.
And you go, yay, tick, move on.
Right.
So the common misconception from most young people is that I have insurance that will take care of me.
Right.
The fact that they haven't scratched the surface to understand what that life insurance does. They certainly don't understand what those three letters, TPD. And I discourage financial planners from using the three letters.
Of course.
It's too profound a situation for you to get that benefit paid, that total and permanent disablement benefit. Think about that. That's a profound state to find yourself in, where you have two medical professionals who are prepared to certify that in their opinion you're never likely to work again in a job that you're suited to, right? And they look at your education, training and experience, but at the end of the day you've got to be in a pretty bad state, Esther. But here's the thing, they see disability and they might not even see income. If they're lucky and they work for say an ASX 200, a listed company, or a not-for-profit that has a real focus on employee benefits, they might have some income protection folded into their superannuation, right? It's never going to be sufficient. The maximums I see these days as what we call default, it's the fries they give you with your super, if you like.
Right.
$135,000 of death and permanent disability cover, and maybe $4,000 a month of income support or income protection for 2 years, right? So it's the most basic of safety nets. But
and
that
what's
is what
2
stops
years when you're a young person in particular? I always had an issue with the cover that was, a set amount based on a unitised cover that decreases with age, because why is there an expectation that just because somebody became a year older that their need suddenly changed? Who knows, in that time their need might have doubled, tripled.
Yeah.
They might have taken on a mortgage. They might have had another child. There's so many life circumstances, and then it's just prescribed that, okay, well, you don't need that anymore. Who said? Who did you have the conversation with?
It's an actuarial calculation, in fact, where it's a one-size-fits-all approach.
Right.
So they're saying, well, if your superannuation balance has increased by $7,000 this year,
right,
you therefore need $7,000 less of life insurance and permanent disability insurance.
Assuming that markets have even performed in that year. So there's so many complex elements to it. And the thing is, again, you get to our stage in life and then you understand why something like that is so important. Yeah. But how do we get the young people to understand that this is something that they need to consider seriously and take on?
I think a really good way of doing it is actually to find all of the GoFundMe pages that have been posted by young people who've basically said, look, I need to have some sort of therapy because I sustained this injury at work. And my doctors have told me this is a really good therapy, but it's not available on Medicare. Or the wait list is so long that I can't wait. I want to get back into the workforce. So that's a good way of getting them focused. You and I are old enough to have experienced throughout our lives enough people we know or friends of friends who've had these situations, who've suddenly been carted off from work, innocuously working away, only to be told, well, you've got an 80% blockage in 4 of your arteries. And we need to get 2 stents into you ASAP, and 2 months from now we'll get you back and put another 2 stents in, right? These are the stories we hear. It's the thing about life insurance and disability insurance and income protection and critical illness insurance is the best time to get it is when you're young and healthy, when it's easy to get, to apply for, and it's inexpensive.
Yes. Yeah, really critical point, Peter, because I find that people in their 30s and 40s are really it's an intense period of life. You're building your career.
Absolutely.
You've got your family. Typically, you've got your highest levels of debt setting in at that point. You're making your biggest commitment, your first purchase of a big home. Typically.
Or the second thing, which is renovating the big home.
Renovating the big home. And so when the cost of insurance is already built in to your psyche of things that you pay, it does become sustainable.
Yes.
It's sustainable when it's the same way that you would pay for electricity, your gas, your petrol. There are things you pay for that, and you find a way to pay for it. It's much, much more sustainable than trying to think about how you have to introduce a new expense.
Absolutely.
But if you're at the peak of all these, critical life building events happening, that is the worst time for something to go wrong. Absolutely.
And look, the point I make there is when you are building a career and you're working for someone else, for argument's sake, it's very different for self-employed people, and we could unpack that certainly today. But when you're building your career, you might be changing jobs, and often when you change jobs, you get a very big pay rise. And financial planners are absolutely right when they say, look, there are some trigger events that you should contact me. Right? I'll certainly contact you once a year. But if you change jobs, if you get married, if you suddenly find you're having a family, changing jobs. There was a period in my life when my income virtually doubled overnight because I changed jobs.
Right.
And was that the time I really started thinking about my insurance? It actually was. I thought about, well, you know what? I don't have enough critical illness insurance. And I didn't have enough because it's something I knew I had to pay for. So it's very easy to find ways to spend that extra money when it's suddenly in front of you. So the right time to go and see your financial planner is as soon as you get that promotion or you've changed that job.
And someone might say, oh, well, you've just had a promotion, you've doubled your income. So there you go, you've got all these excess funds. But typically, if you are doubling in your income, it's because you've already thought of ways you need to spend extra money, and therefore you've sought something that's going to double your income. It's all accounted for. It really needs to be built in. But just going back to how young people can be introduced to the concept of cover, because a lot of young people are not going out and seeking financial advice or speaking to an insurance specialist. But where do you think parents come into it, and how parents can be more engaged? Because I've got some ideas myself, but I'd love to hear what you have to say about what more parents can be doing to speak, whether it's speaking their children or just, I want to hear your ideas and then I'll share mine.
Yeah, no, that's great. Look, it's no secret that you and I have adult tax-paying children.
Right.
So we've been through that part of our life. The thing for me with children that came into very sharp focus was when our kids were in kindergarten, the impact that a parent getting sick or a child getting sick can have on that family, who are understandably and absolutely become focused on nothing but the well-being of that family member, of that child or of that mother. Right? The bottom line for me was, okay, someone is stopping work now to take care of a sick child, to support a sick child, to do all of the things you need to do. Now, we're in a city, we're really lucky. We can go to the children's hospital in our car, and if we have to come back tomorrow, we'll go home tonight and we'll come back tomorrow. And the biggest expense will be the time out, right? The time out of work if you're self-employed, the car parking, right?
That's probably going to be one of the biggest expenses.
That's it. But you can put that in the context of, well, hang on a minute, what if you're coming from out of town? What if you're from Gippsland? What if you're from a region?
Yeah, you need accommodation. There's all sorts of things.
So that comes into sharp focus. What's the impact on this particular family that now that this child has leukemia and is getting treatment, right? So the mindset that I've always had around parents, and certainly to practitioners, is it's the most ghastly thing to talk about. Right? But if you want to start as a practitioner by doing the right thing in your recommendations for your clients who have dependent children, the simplest thing to do is to ensure in your recommendations that you've set the children out as insured lives under the parents' policies, right? And I've always had a very simple rule of thumb for those parents. It's not discussed during the fact-finding discussion. You've taken that information in, you know the kids' ages, you know their names. You might even know the name of the dog, you might know the football teams everyone barracks for. But bringing it back to the kids and saying, all right, I have put cover in place for Zoe and Zach, right, from age 2, and I've based it on both income earners, so aggregating the after-tax or the take-home pay of the mother and father who are both income earners, or if it's one income earner, and I'm making that 1 year or 2 years. That's support that I can present to my client, who'll come back and they might be a little bit taken aback when they see my children's names and the sum insured, and as soon as I explain, no, look, just understand, we don't need to talk about this other than that's the cost, which is very low. We're talking $200 or $300 a year. But that sum insured is based on your after-tax income for 2 years. And every financial planner that's done that I've taught has said that was great advice. All of my clients with dependent children now have this cover.
Right.
So we're preparing
what you're saying is that if the parents take out cover, because there is cover that you can get for children, unfortunately incidents do happen to children as well, so that if for the parents who take out cover on their children, when their children become a certain age, they can then take over the cover themselves.
Absolutely.
One thing that I've always been mindful of raising with my clients, particularly some of my older clients, is that they're paying for insurance for themselves. They obviously saw the benefit and the value over time, but then they're getting to an age where it's no longer necessary. Their kids are older, and it's quite costly in their end, but they don't need it anymore. They've accumulated enough wealth through their own means, through inheritance, whatever, that they no longer need it. They can self-insure for an event that could happen to them later in life. The thing is though, the conversations that I've had is you're still willing to pay for this cover. How do you feel about pivoting to paying for your children to have cover? Even though, as I said, the children should take it on themselves.
Yes.
But for the ones that don't necessarily want to take it on themselves or can't for whatever reason, that the parents pivot the cash flow that they're spending on their own insurance, which they don't need for themselves.
Yes.
So ultimately what it is, it's taking something that's a windfall for the children.
Yes.
If the parents die, the parents
Yes.
don't need it, but it's an extra windfall to the children. But the thing is, if something happens to the children, who's gonna fund that? And typically they would come back to the parents, and we're not talking about underage children, we're talking now about adult children, and how that potential claim could impact the parents' retirement,
Yes.
their aged care, future inheritances of their siblings, because money has gone to be spent on the, and so that for me is always something that I'm mindful on. Why are you paying this for yourself when you don't need it? And if you're happy to pay for insurance, your need now is not to insure you, it's to insure your children, because they will be coming to you if something goes wrong.
It's a natural reaction to not just give support emotionally and practical support if you're looking after your grandchildren, to then say, well, what do these kids need? What do my children need financially? All right, so that's a natural reaction. Esther, the first thing I'll say is when you don't need insurance anymore, you've paid the premiums. I understand the mindset.
Yes.
Like, surely this can pay out one day. Look, that's not a practical way to think, and you, as a financial planner, you know that. So I'll say this. There's a secondary market for life insurance policies in Australia that aren't needed anymore, but that's a discussion for another day.
Right.
So there's still a way to get paid, just someone else will pay the premiums. Now, your children actually do present, and you use this term, I love it, unexpected dependency.
Right.
I call it unexpected intergenerational dependency. So this is really where we're coming from. Think about the number of families now. If the bank of mum and dad doesn't exist, it exists in a quasi sense where lenders are increasingly asking parents to sign guarantees in addition to the mortgage they hold over the property, because the valuation ratio is beyond what they're prepared to take on. They don't have appetite, Australian banks. So you could be thinking of that. Often I'm told, oh, not only that, I'm actually guaranteeing my child's business.
Oh, wow.
All right? So these are common things. And for families or for older clients who have self-employed children, these are considerations and questions that you could be firing at your clients first up. Because if someone else, a third party, has a hook potentially over your client's assets and wealth, that's a sure enough call to action for them. Right? So that's the first thing I'll say about self-employed children. Regardless, you know that if something happens to your child, you're going to step in. So you make a lot of sense when you say, well, Peter, why don't you have a look at that secondary market for your life policy that you don't need? If that frees up, and I've seen crazy amounts, $3,000, $4,000, $5,000 a month of people my age or older still paying for life insurance they don't need.
I think there's this mentality that you've paid for it for so long. What if I cancel the policy and tomorrow I have a heart attack? But it's like, that's okay, because if you have the heart attack tomorrow, you have more money than you need, plus extra to pay for that, which is replacing the insurance that you have. But essentially, we really do need to be more mindful about how we can get younger people in and understand the different types of cover. So can I ask you now about income protection? Income protection has changed over the last few years. Can you talk about not so much the changes on income protection, because anyone who gets a new policy now will be in the new regime. But can you explain why the new regime exists and what people can expect from an income protection policy?
Sure. Look, people will be surprised when I say that Australian life insurance policies, and this includes income protection, are amongst the most generous in the world with their terms and conditions. Competition, despite the shrinking of the market in terms of life insurers in Australia, drove life insurers to create some policies that were very, very generous.
Right.
To the extent where over a couple of years in the mid-2000s, they found themselves underwater, the industry, to the tune of $1 billion just for this one type of cover.
Right.
Right? The sorts of things that were happening were someone would go and get a couple of stents, or 3 stents usually, and without losing a day of work, or maybe, hey, I had sick pay and I only took a day off work for the stents, for the very quick surgery,
Yep.
but I suddenly found myself receiving a multiple of my sum insured that was 3 times, and I happened to be insured for $10,000 a month, right? And I didn't miss a day of work. The principle of life insurance, of any kind of life insurance, is to indemnify you for a genuine loss. What this example was, and it was definitely happening, was a windfall, in effect, right? And we have this mentality that has been shaped by these life insurers. The regulators, who of course are responsible for making sure that life insurers can pay claims, stepped in, and they basically, in a sentence, said, look, you will only indemnify people for loss, and we're only prepared to let you indemnify people for loss equivalent to 70% of their pre-disablement earnings.
Right.
Right. That's it in a nutshell.
Yes.
So they will look at what you've earned in the year or 2 years, if you're self-employed, before you became disabled, and give you no more than 70% of that.
Right. Now, for some people, they might find that to be a deterrent to having cover and say, well, how does 70% help me? I need my whole income. But we know that people who are on a claim for an extended period of time, or people who don't have insurance, who are dealing with medical issues and have the concerns of money, often the issue is not, well, the extended issue isn't just the issue that prevented them from working. There's the flow-on effects, the mental health impacts, the other things that happen that arise because someone couldn't work. So I do think that it's fair that a significant amount of a person's income is paid, but that there is still an incentive where a person can heal and return to work, that they return to work, because we do know that people who have left work for medical reasons and who have stayed out of work, their health generally deteriorates. It's not a win to get paid out by insurance for the long term. The win is to get back to work as soon as possible.
It is. It's a return to health. I like that word you use, heal. We should use that one more. We need to heal ourselves of our ailment, but also heal our minds. And often work, whether you like it or not, a lot of us are defined by work. Well, we have a strong connection, identity. If you love what you do, you never work in your life. But you know, a lot of us, you know, are very passionate. Well, certainly you and I are passionate about what we do, and I'd hate to think that I wouldn't be able to continue doing what I'm doing because I just don't have cover there to protect me if something happens. And look, to your original point about, well, why would I only insure 70% of my income? Well, there's the incentive to return to work, to heal and return to work and heal yourself. But also, look, if it is that situation I described earlier, that stroke that needs 6 to 12 months of intensive rehabilitation, that is why a financial planner will always recommend additional insurance in the form of critical illness or trauma. And that is
fills
a serious...
the gap.
It fills the gap.
I mean, obviously, there's a lot more detail to it, and probably too much detail to go into in this chat. But the important thing is for people to be aware that this is something that they really need to consider if they're serious about their preserving their independence, their self-dignity, if they want to feel some sort of responsibility to their loved ones and other people in their lives, not just for protecting them and down the chain, but up the chain, protecting you know, your parents and your extended family's financial well-being. And that, you know, it's just one of those painful things like paying for car insurance and paying for travel insurance. And I can tell you, Peter, I am someone who's had a fire at my house. So I have had a significant insurance claim paid out for my home fire nearly 25 years ago.
Right.
I have made a travel insurance claim.
Yes.
I wrote off a car. I don't think insurers like me. I've made insurance claims everywhere. And when you have a good quality policy, they pay.
They do.
They pay. You know, you do get what you pay for, but at the same time, you shouldn't have to overpay. You're not going to spend half your income protecting your income. It has to be sensible. It has to be packaged in a way that is palatable and sustainable, is what I say. But you have to have it.
You do.
You have to have it.
And look, we know that if you look at the regulators' websites, the industry in Australia, the life insurance industry across those policies, is approaching somewhere around $8 to $9 billion a year in claims paid. That's to average Australians who never expected to claim on these policies.
Yeah. It's amazing when you have, I don't love when I have to do a claim for someone, but I like when somebody isn't aware that they can make a claim, and I'm the one to say to them, do you know what you've just described to me is something that you can claim, and let's go down the process and see what comes out of it. And then, so that's something that I think we should spend a few minutes discussing, is how people approach claims.
Yep.
Because I think for some people, they self-determine whether something's claimable or not, and they go, hang on a minute, we had a surprise situation with a client who is doing very well, is up and about and didn't take much time off work, but did have an event that satisfied a claim that enabled him to pay out his mortgage. And thank God he's doing very well. But the thing is, people self-determine.
Yes.
Like, number one, if you are paying for cover, don't self-determine what's claimable or not.
So true.
I can't always guarantee that you'll have a successful outcome, but we've got to ask the questions.
Esther, you do, and often one of my clients, a practitioner like you, who doesn't know insurance too well, will contact me and say, Peter, I think I've just discovered a claimable event, but it happened 6 years ago. And my answer is always the same. If your client had a policy, that policy might not exist today, but if at the time of that event they had a policy and it was paid up, we claim.
Yeah.
Insurers don't like it, but the contract existed in that point in time when that insurable event happened.
I've had one or two situations where the insurer has asked more out of curiosity, and it wasn't that they were looking not to pay, despite that some people have that perception that insurers don't pay. But it's like, well, why have you taken so long? Like, this event happened a long time ago. Why are you coming now? And the answer could just be very simple. I didn't know I could claim.
That's exactly right.
Someone's frame of mind was so fragile that they just were not in a position to confront or deal with paperwork, and, you know, while they were dealing with perhaps the mental health impacts of their circumstances, it was way too confronting to deal with putting in an insurance claim. And the insurer has said, okay, that's fair, we understand, we just needed to know why.
They always ask, but inevitably I find they always pay.
Yes, in genuine circumstances when there's been absolute and full disclosure, they will pay. And we've paid out quite a bit of money on behalf of clients. We actually have a big claim going through at the moment that will be absolutely life-changing if and when it comes through. So ask me about that one in a few months. It's unfortunately will take a little bit of time to go through. It's one of those type of claims, but we anticipate that it will be successful. And I am so glad that I'm dealing with it, because what a lot of people don't realise, or when they wake up to the fact that they could make a claim, if they don't have a relationship with a financial advisor, they're going to the lawyers. And sorry, lawyers out there, but you really shouldn't be charging 30% of someone's life insurance policy to help someone make a claim. We know how to do claims. Our industry, we've written the policies, we've got relationships with people who are in the insurance companies, and please, anybody who's listening to this who may have a claimable event or could have a claimable event in the future, please see a risk specialist or your financial advisor. Even if it's someone different who set up the policy for you and you're still holding on to it, or that you had, because the financial advisor will get you the best outcome possible and at a lot less cost.
Yes, and look, I don't begrudge lawyers for what they do, but I find it interesting that their success fee is up around 30%. For doing something that is a very simple execution of a contract outcome. Right. Now, I understand that clients are overwhelmed and their state of health is anxiety inducing at that point in time.
Absolutely.
But the best person, the best qualified person, and the person that will charge you a reasonable sum to advocate on your behalf and manage that claim is a financial planner. So if your policy or your anniversary notice, your renewal notice has the name of a financial planner, each year when you get that notice, that's the person to call first. If it doesn't, please, before you go to a lawyer, look for a financial planner that can help you.
Yeah, absolutely. You mentioned the word advocacy and you remind me of a scenario that I had a number of years ago where somebody came to see me and said, I'd like you to set up an insurance policy for me. I've been recommended to you, I've heard about you, and I'd like you to do this for me because you're somebody who I have confidence will fight for me. And I said, whoa, hang on a minute. What do you mean fight? I don't always love a good fight. I wish I didn't have to fight so much. But
I describe you the same way, Esther.
That's
right.
right.
I want you on my team.
Yes. Okay. So I actually said to him, you might come to the wrong person because when I'm giving advice about insurance, I'm not selling you a fight. I'm selling you certainty, not a fight. Yes. Okay? I'm selling you certainty. And so if you want me to advocate for you and if you want some level of certainty in certain circumstances, then I am happy to work with you, but don't engage me to be a fighter.
You're absolutely right.
And he said, okay, you know what? I'm going to change my language. Can we reset? And we reset the conversation. And I did take him on. Unfortunately, many years later, it did actually become a claim, sadly, and I didn't have to fight.
No.
I did not have to fight. But if I had to fight, I would. But it's not fighting, it's advocating. But if you have good information up front and people have shared, they've been honest and fully disclosed, then you can with confidence know that should a particular event happen down the track, a payment can be made.
That's it. And you can remove yourself as the person who's going through this health situation by letting someone else do it for you. And someone who's done it before or does it regularly.
Right. But let's just do it. Just do it, right?
I couldn't agree more.
Just do it. So, Peter, as we come to the end of our conversation, is there anything that you feel you'd like to tell the audience that we haven't touched on?
Oh, look, I can speak from my recent experience with one of my practitioner clients that is not as accomplished in life insurance as you are, Esther, which is why they've engaged me. And it would be, if you, as a consumer, if you have a policy, any kind of insurance policy, but the example I'm thinking of is an income protection policy and one of those very generous ones that we spoke about earlier.
Yes.
A person suffered a workplace injury. This policy was put in place in 2018, thumbs up, long time ago, but it had never been reviewed.
Okay.
Right? And the policy was not implemented by the current financial planner. Albeit the current financial planner is now the servicing advisor for that policy, they didn't implement the policy. They effectively acquired the client through merger and acquisition. The policy had never been reviewed, and despite it being the practice's modus operandi to actually send letters each year to say, hey, it's been a while since you looked at this, client never got time.
Right.
And there was a poison pill in the policy, Esther. When it was written, notwithstanding the fact that it was for a very low sum insured per month, These days it had increased to $4,000 a month, peanuts.
Right. If that's what it increased to, that's pretty low.
It started really low in 2018, and ultimately it was just CPI that caused it to go where it was.
Right.
The individual had what was characterised as an agreed value policy. What was never discovered was that financial evidence was never provided to support the original sum insured. And the person went to see that advisor at the time, was very young. And because it was such a low amount, oh, don't worry about the income, we'll deal with that another day. Never reviewed. Turns out, long story short, workplace injury, he actually only should ever have been insured for half the amount.
Right.
From the outset. Now, notwithstanding the fact that his income today could justify the sum insured, the poison pill in the policy, the wording was that if you don't give us financial evidence, we will look at your financials at the time of applying.
Right.
Okay. And he was actually never entitled to the sum insured that the insurer gave, but policy wording, and perhaps the financial planner at the time, should have badgered him afterwards to say, let's get your financial evidence. That policy endorsement that said we'll only look at that income at the time of applying could have been removed. Might not even have needed to change their policy. So that's one example. The other point I'd make, really simply, again, to those of you who have policies that haven't been reviewed, you're probably paying too much. And the examples that I see now, and it's not about loyalty, right? It's an actuarial calculation. The longer your policy is in force for, the more you will pay relative to someone who comes to an insurer or goes to Esther and gives a new medical declaration. Answers all those questions based on my health today, not on my health 20 years ago, right? So the sorts of examples I hear, like for like, Peter, even if we don't reduce your sum insured, we might still do that because you're mature enough and you probably have too much cover. But even if we didn't reduce it, Peter, we could probably save you 30 to 50% dollar on dollar. But you have to be healthy, first of all, first and foremost. And you need to be accepting that the insurers at my age certainly is going to want to know a few things about my health. And they might request blood tests. So it's an inconvenience. But what inconvenience to halve my premiums?
Oh, absolutely. And I think there are a lot of people who, you know, get to our age and say, oh, well, now I've had this, I've had that, I've had all these different things, and insurer's not going to want to look at me. But that's absolutely not the case.
Not the case.
And there are so many conditions that are not a concern to an insurer, conditions that may be a concern when someone's 25 or 30, but that concern is perhaps no longer there later. So the same way that people shouldn't self-determine when it comes to a claim, they shouldn't self-determine. There's certainly some pre-qualifying questions that we can ask. But ask your advisor, ask the questions, we can ask the questions back, but don't do nothing.
Absolutely.
Because why overpay? We would never overpay for anything else, so why overpay when it comes to this? And look, I see it all the time that yes, we redisclose and people get the cover they need or retain the cover that they need, but at a significantly reduced cost.
And if you're following doctor's orders, and let's talk about the two really regular things that people get prescriptions for at our age, cholesterol and hypertension, blood pressure. If you're following doctor's orders and you're taking your medicine, that's priced as a normal person. So don't be afraid.
True. Well, Peter, this has been great. I really appreciate you having this conversation with me. I see you around the traps. You know, it's great always to have our little chats about what's going on in the insurance space. As you know, I have spent a lot of time over the last few years developing my business more so with intergenerational conversations and people retiring. But I think as my client base has aged, and as we're dealing with more of our clients' children and considering the next generation, insurance was something that I took a little bit of a backseat on, but have said, no, we really need to put this as a focus into the business again, because how can I look after my aging clients with integrity if I am not finding ways to look after their children?
100%, Esther. And that's how you're going to ensure that your clients in retirement can enjoy their retirement and not worry about money.
Absolutely, absolutely. So thank you so much, Peter. And it's been a wonderful chat. And we will see you again soon.
I look forward to it, Esther.
Thank you. And thank you, everyone. If you have any questions or you'd like your insurance policies reviewed, please feel free to reach out to us at Perspective, and we'd be happy to have a chat and see how we can help you. Thank you.
Take care.